Good morning, everyone, and welcome. Thank you for taking time to join us for Frontline Perspective webinar on the large Canadian banks Q2 2023 earnings roundup and outlook. My name is Shokhrukh Temurov, Vice President, North American Financial Institutions at DBRS Morningstar, and I will be the moderator for today's discussion. The Big Six Canadian banks have faced challenging operating environment and headwinds from persistent inflation, higher interest rates, heightened macroeconomic uncertainty, and the U.S. regional banking sector turmoil. As a result, their Q2 2023 earnings performance were negatively affected. My colleague Carl De Souza will provide an overview of key performance factors for the six large Canadian banks, including profitability, asset quality and credit risk, liquidity, funding, and capital levels. Carl will be referencing the recently published commentary titled Large Canadian Banks Q2 2023 Earnings Roundup, PCLs ramp up driven by weakening credit quality and economic concerns. We would like to note that our banking rating universe includes issuers of different size, and quite often we use large Canadian banks as a proxy for the banking industry. Following the conclusion of the discussions, we'll have time for questions. So please submit any of your questions, even if they fall outside of the material discussed. Please submit questions via Q&A box on your Bright Talk screen as they arise during the presentation. We're currently experiencing technical issues with video quality of our webcast platform, and we are working through them. We apologize for any inconvenience caused to you. Without further ado, I would like to turn it over to Carl, who will take a few moments to introduce himself before we begin our discussion. Thank you.
Thanks, Shokhrukh. As Shokhrukh alluded to, I'm Carl De Souza. I'm a Senior Vice President in the North American Financial Institutions Group, and I lead the Canadian banking team here at DBRS Morningstar. And also, as Shokhrukh alluded to at the beginning, the Big Six Canadian banks are facing a challenging operating environment. So what we'll do is we'll start off with a little bit of a review of the Q2 2023 earnings from the large banks. The quarterly sequential earnings were negatively affected by a surge in provisions for credit losses, or PCLs, along with lower revenues resulting from moderating loan growth, rising funding costs, and a continued challenging environment for capital markets and wealth management business lines. As Exhibit 1 in the presentation illustrates, aggregate quarterly adjusted earnings decreased 11% quarter over quarter. So credit metrics continue to normalize from unsustainably low levels during the pandemic, although the quarter over quarter ramp up in PCLs in the quarter was higher than we expected. Aggregate net interest margins, aggregate net interest income decreased by 4% quarter over quarter as net interest margins, or NIM, contracted, and aggregate total gross loan growth was modest at 1.5% sequentially. And moving on to the next slide, Exhibits 2 and 3, you'll see that loan growth was largely affected by Canadian real estate secured lending volumes, or RESL, which were up only 0.4% quarter over quarter, however, up 4.3% year over year. That's in Exhibit 2. While non-retail business loan volumes had exhibited strong momentum during fiscal 2022 and helped to offset the moderating RESL volumes, year-to-date growth in fiscal 23 for business loan volumes has been somewhat muted, with a 1.9% growth quarter over quarter, and this is considerably down from the year-over-year robust growth of 15%. Loan growth for the remainder of fiscal 2023 is expected to be negatively affected as a result of materially higher borrowing costs, macroeconomic uncertainty, including a potential recession, and tightening credit availability. The RESL growth outlook is in the low to mid-single digit range. Additionally, NIMs, or again, net interest margins, are expected to remain pressured in fiscal 2023 as funding costs increase following the U.S. regional banking turmoil.
Thanks, Carl, for the overview. So you mentioned that the ramp up in PCLs in Q2 2023 was higher than expected. So can you expand upon credit performance in that quarter and your outlook for the remainder of 2023?
Sure. So with regards to credit quality of the Big Six, it remains sound. So that's the first thing to take away. However, Exhibit 4 in the slide presentation illustrates that credit normalization continued to accelerate in the quarter. Aggregate total PCLs, aggregate total PCLs increased 12% sequentially to 2.7 billion in Q2. Looking at the breakdown of this 2.7 billion, PCL on impaired loans notably increased sharply by 17% quarter over quarter to 2.3 billion, more than offsetting the second quarterly decrease in aggregate PCL on performing loans, which reduced to 485 million. So what you're seeing is, as we moved through the pandemic and started coming out of the pandemic, there was releases on those PCLs on performing loans that were taken at the outset of the pandemic. So those are coming down, but on the flip side, the other component of provisions for credit losses or PCLs are increasing, and that's the PCLs on impaired loans. Aggregate total PCL as a percentage of average net loans increased quarter over quarter by 4 basis points to a total of 28 basis points. Additionally, aggregate gross impaired loans or GILs increased 7% quarter over quarter, while aggregate GILs as a percentage of total gross loans and acceptances deteriorated sequentially by 2 basis points to 45 basis points. When we look at the allowance levels, the allowance for credit losses on loans or ACL ratios increased quarter over quarter as a result of increasing macroeconomic uncertainty, high interest rates, and persistent inflation. The increase in non-retail or business ACL ratios was driven primarily by commercial real estate exposures, particularly in the office segment, which have become a heightened concern and focus. Retail allowance levels have also been on an increasing trend in the last 3 quarters, and this is considered prudent as a result of evidence of credit deterioration, primarily in the unsecured loan portfolio, such as credit cards and auto lending. Credit metrics are approaching pre-pandemic levels, and we expect to see further deterioration in the second half of fiscal 2023 from these still unsustainably low levels. The Bank of Canada's recent June increase in its overnight rate by 25 basis points will further increase borrowing costs, likely amplifying credit deterioration in the second half of fiscal 2023.
Thanks, Carl. Has the U.S. regional bank turmoil since the U.S. bank failures in March this year had any material impact on funding, liquidity, or capital of Canadian banks?
That's a good question. I mean, that was the concern, obviously, when we had the initial U.S. bank failures in March. However, looking back at how it all unfolded, the Big Six maintained strong funding and liquidity profiles despite the U.S. banking or regional banking turmoil, with liquidity coverage ratios averaging 136% in the quarter. Meanwhile, the net stable funding ratio, which looks at funding resilience over the medium to long-term horizon, was also strong at 116%, with both ratios above the regulatory minimum thresholds of 100%. Deposit levels, which by now we all know what happened with the U.S. banking failures in March of this year, where SVB lost a material amount of deposits in a very rapid fashion, leading to its demise. At the Canadian banks, deposit levels have remained relatively stable, although U.S. deposits had experienced some runoff prior to the U.S. regional banking turmoil. So in the U.S., prior to the U.S. bank failures, U.S. deposit balances had been coming down, and in general, U.S. deposit balances had proportionally been higher than Canadian deposit balances, so they started coming down in a disproportionate fashion relative to Canadian deposit balances. But from what we had seen post-March, when the U.S. bank failures, the U.S. deposit levels remain fairly consistent, and with the large Canadian banks who operate in the U.S. And so that leads us to believe they were not really beneficiaries of what happened in the U.S. From a deposit standpoint, nor were they materially negatively impacted from a deposit standpoint. Additionally, unrealized losses on the investment securities portfolio remain manageable, especially when taken as a percentage of total assets. Those two components, with being the unrealized losses and the deposits, were the sources of the U.S. banking stress in March. So from a Canadian large bank perspective, they ended up coming out quite well out of that turmoil. As Exhibit 5 in the deck illustrates, capital levels at the Big Six remain sound and provide sufficient cushion to absorb potential losses. The aggregate CET1 ratio decreased quarter-over-quarter to 13.3% from 13.7% as BMO closed its large acquisition of Bank of the West in the quarter. This aggregate CET1 ratio remains artificially high, however, as TD and RBC are holding excess capital as a result of M&A activity. With TD's recently canceled or terminated purchase of First Horizon Corporation, however, it will now be allocating some of this excess capital with its intention to repurchase for cancellation up to 30 million or 1.6% of its outstanding common shares. That decision was not totally unexpected in light of the excess capital they were holding for the anticipated acquisition, which is not going to take place. As well, RBC is working on their acquisition of HSBC Bank Canada, and they are looking at closing that transaction in Q1 of 2024. And so their capital levels will reduce as a result of that acquisition closing, somewhere to around likely the 12% range. The Big Six all continue to maintain adequate capital buffers above the current CET1 regulatory minimum of 11%. On June 20th, just last week, however, the Office of the Superintendent of Financial Institutions raised the Domestic Stability Buffer, or the DSB, to 3.5% from 3% of total risk-weighted assets, effective November 1st of this year. And that's only for DSIBs, obviously, which the Big Six Canadian banks are. As a result, the minimum CET1 capital requirement increases from 11% to 11.5%, and the total loss absorbing capacity, or TLAC requirement, rises to 25% from 24.5%. When we looked at, the Q2 results prior to OSFI's announcement, the Big Six generally appeared to be managing to a CET1 level of at least 12% ahead of the OSFI's DSB announcement. And so leads us to believe that, they were anticipating or at least were getting prepared for another increase from OSFI, which came to fruition last week. And so when we look at the ratios from Q2, they already meet the new higher CET1 requirement. Furthermore, we view the large Canadian banks as being able to take additional actions to boost capital levels as necessary in order to align with the new higher regulatory requirements. Additionally, the Big Six had an aggregate total loss absorbing capacity, or TLAC, as a percentage of risk-weighted assets of 30.3%, with each of the Big Six already above the new higher regulatory minimum of 25%.
Thanks, Carl. So when announcing the increase to DSB, OSFI, citing heightened concerns around high household and corporate debt levels, rising cost of debt, increased global uncertainty around fiscal and monetary policy. So can you speak to some of these concerns, particularly around the household debt levels and materially higher borrowing costs?
Sure. I don't think any of these heightened concerns OSFI highlighted in their DSB announcement were new, and they've been around, and OSFI has been flagging these concerns for a little while, although, the fiscal and monetary policy that continues to be uncertain. With respect to elevated household debt levels and high housing prices, these two remain two key interconnected vulnerabilities in the Canadian financial system. Both the Bank of Canada and OSFI have previously flagged these, and they continue to remain vulnerabilities. As Exhibit 6 in the presentation illustrates, the household debt to disposable income ratio deteriorated by 283 basis points sequentially to 184.5% in calendar Q1 2023. Low interest rates and easily accessible credit have fueled debt levels, with high and rapidly growing housing costs forcing Canadians to take on larger mortgage levels. And these mortgage debt levels are the largest component and an increasing share of the total debt that's factored into this ratio. While the housing market has been slumping since the Bank of Canada started raising interest rates in March of 2022, the Bank of Canada's temporary rate pause that started in January of this year prompted a recent uptick in home buying activity, with home sales rebounding 11% month over month in April and 5.1% month over month in May. National home prices also increased 1.6% month over month in April and 2.1% month over month in May. However, with the Bank of Canada's 25 basis point recent rate hike in June 7th of this year, this rebound in demand for housing will likely wane. And the other factor to consider when you're looking at housing prices and a potential, further drop in housing prices is that there are things that support housing prices and embed somewhat of a floor on the drop in housing prices. And some of these things include structural supply challenges, and it's been well discussed in the past about the housing shortage across Canada, particularly in the main cities and provinces of British Columbia and Ontario. There's record levels of immigration that are happening, and this not only spurs increased consumption, but also demand for housing. And there's also pent-up demand. From the pandemic, and you could see that when the Bank of Canada put a pause on rate hikes in January, things started to rebound a little bit and pick up. So likely some of that pent-up demand from the pandemic and when interest rates started increasing is still there, and that will continue to support housing prices. Canada's household debt as a percentage of its GDP is the highest of any G7 country and is the only country above 100%. So this makes Canadians more susceptible to interest rate hikes and more vulnerable to any potential increase in unemployment. Surprisingly, however, the labor market in Canada has remained tight, and economic performance remains resilient, although we've seen some deterioration in recent numbers. Now, when you look at interest rates, the materially higher interest rates, combined with elevated inflation pressures and high household indebtedness levels, are shrinking disposable incomes. Variable rate mortgages became very popular during the pandemic, but the aggressive interest rate tightening cycle by the Bank of Canada since March of 2022 has caused a sharp spike in variable interest rates. As Exhibit 7 in the presentation illustrates, variable rate mortgages now represent only about 9% of new uninsured mortgage originations as at April 2023, compared with a peak at approximately 60% in January of 2022. This was somewhat expected as variable rate mortgages took off when the spread between the variable rate, the very low variable rate, and the fixed rates at the onset of the pandemic was wide enough, and it incentivized a lot of people to go into variable rate mortgages rather than the most popular term traditionally in Canada, which is a 5-year mortgage term. Additionally, recent originations also indicate that as I mentioned, the most popular term historically has been 5-year fixed rate mortgage, but recent originations indicate that the most popular fixed rate term is right now a 1 to 3 year term, as borrowers wait for the uncertainty around interest rates to play out. Additionally, variable rate mortgages currently represent a still significant 38% of outstanding uninsured mortgages in the Canadian market. And these variable rate mortgages do expose borrowers to rising interest rates. The majority of these mortgages, however, have fixed payments. And what that means is in an environment of rapidly rising interest rates, more or all of the fixed payment goes toward interest. And as interest rates have been rapidly and aggressively increasing, the majority of those fixed rate payments are going towards interest, and if not all payment is going towards interest. And to extend on that, sometimes the fixed rate payment is not even covering the interest accrued and owing, and that is referred to as negative amortization. As a result, amortization periods have been getting extended to account for reduced principal repayments, as well as the negative amortization I just alluded to. In this situation, the payment shock is deferred until renewal, potentially delaying identification of high-risk problem borrowers, and as well the ability to take more timely remedial actions. So while borrowers are able to maintain their affordability on their current payments because they're fixed, you eventually have to pay the piper. And so when these mortgages come up for renewal, they will have to address the extended amortization. And there's various ways they can do that. They can look to refinance, make their payments more affordable. They can look to, as well as refinancing, work out some arrangements with the lenders, and so on and so forth. But at that time of renewal, actions will have to be taken. So really, it's just a deferral rather than addressing the situation right now of the materially higher borrowing costs. And Exhibit 8 in the presentation illustrates the rapid and significant increase in the greater than 30-year amortizations since the interest rates started increasing in Q2 of 2022. A couple of notable items in this chart are that you'll see 4 of the big 6. You'll notice that those greater than 30-year amortizations have materially increased, and that's because those 4 large banks or DSIBs have fixed rate payments. The other 2 do not. They have adjustable variable rate payments. So Bank of Nova Scotia and National Bank, they adjust their variable rate payments with increases in interest rates. So that's why you don't see much change there during from quarter to quarter since Q2 of 2022 for those 2 large banks. Additionally, TDs has a slight blip because they adjusted their reporting, or if you want to call it their amortization reporting methodology in Q1 of 2023. So they only restated their Q4 numbers. So that's why you see the spike in greater than 30-year amortizations for TD starting Q4, because prior to that, they were using a different amortization reporting methodology.
Thanks, Carl, for your insight. So this concludes the presentation. So our last 2 slides before we enter the Q&A session present a snapshot of ratings and trends for Big 6, as well as our research commentaries since our last Canadian banking webinar in February of this year. As you can see on this slide, we maintain stable long-term trend for all of these banks. Now we're entering the Q&A to answer some questions. So there are a couple of questions we have received already, so we can start the first one. The question is, can you speak to the differences between the US banks and Canadian banks as it relates to deposits? Why using the Canadian banks deposits sticker?
Okay. So with regards to that question, the banking landscape in Canada is very different than the US. The US is a large and fragmented banking landscape with many players, very small players, some medium to small size players, some what they call super regional players, and then the large 4 banks. And in Canada, there's really the big 6 banks that dominate the market, both from a loan standpoint as well as a deposit standpoint. And so what normally happens in liquidity crisis, or as they call it, a run on deposits, when confidence is shaken in an institution, is there's a flight to quality. So what you would have seen and did see in the US is that a lot of the deposits from the smaller regional banks went to the large banks, such as Bank of America, JP Morgan, and so on and so forth. And that is what you've historically seen. Whereas in Canada, the majority of the deposit market is owned by the big 6. And so the big 6 is already there. And so the choice would be to pull it out from one of the big 6 and put it in another big 6, right? Unless there's something specific to one of the big 6 banks that is of concern, which in this case there was not. It was more we were looking for market impacts in Canada as a result of the situation that occurred in the US. So the fact that the big 6 are very well diversified and institutions and globally strong institutions really helped. And you saw some of this, although the circumstances were a bit different in the financial crisis as well in 08, 09. And then now again. And so to further expand upon that, when you looked at SVB, that was the first bank to fail in March in the U.S., they had a very concentrated depositor base, and that concentrated depositor base had larger deposits. So that in the end, through all the analysis that's been done, you can see that was kind of a recipe for success. They were also, a lot of the majority of their deposits were from a boom and bust industry such as tech, right? So when you look at the big six banks, they do not have that. They have broad-based, well-diversified depositor bases, and they're not concentrated in tech or any boom and bust industry, and so that breadth and depth of diversity in the deposit base really helps, as well as the fact that the big six are considered the safest haven, and they own and dominate the deposit market here. So I think those are the primary contributors to why you saw more stability there. We even saw, because our coverage universe covers obviously beyond the big six, we even saw, in our medium-sized bank and credit union space, that deposits remained relatively stable. So it was a good thing to see the Canadian banking and financial system, was able to perform relatively well in a period of heightened uncertainty and turmoil.
Thanks, Carl, for your insight. So we have there is another question we received. With OSFI's recent increase of DSB requirements, so what impacts do you see for banks?
Okay, so I think, as I had alluded to in my comments earlier, the DSIBs already meet the new higher regulatory minimum of 11.5%. And then also something to keep in mind is that new regulatory minimum of that goes up by 50 basis points doesn't take effect until November. So the large banks still have 2 full quarters to increase the buffer in capital through internal capital generation and things like that. So they have an implementation period, which OSFI always provides, to be able to build up those capital buffers even more than they currently are at. The other aspect there is that if you look at the Q2 numbers that are in the slide chart, and we can go back to that slide that shows the capital levels at Q2. So if we're moving back to that slide in the deck that show those capital levels right there, you'll be able to see that the bank that's the lowest there is CIBC 11.9, so they're roughly 40 basis points above the new higher minimum threshold. And then RBC as well, because it's an approximate, but once the HSBC transaction closes, they will be around the call it the 12% mark. And so if that ends up being the case, and they do need to raise capital, there's no real concerns about any of these big six being able to easily issue equity and raise capital. We saw that with the prior DSB increase that took effect, and when BMO raised $3.15 billion in equity in a combination of public and private issuances, and to fortify or increase their capital buffer in light of what OSFI did, and they were able to easily do so. So we are fairly confident that the big six could access the capital markets and do equity issuance if need be. And as well, they have flexibility around things like increasing their dividends, share buybacks, although TD share buyback, as I mentioned earlier, is a little bit of a different situation. TD has exorbitant and excess capital levels because they are unexpectedly holding those levels because the transaction with First Horizon did not go through. So the assumption is they will proceed with those share buybacks that were just announced or recently announced. But there is that flexibility with the big six to not do or do share buybacks. So there's various mechanisms that can be used as well there, once the new threshold is implemented in November.
Thank you, Carl, for your insight. So we have one more question. I'm just paraphrasing the question. So what are your views and expectations on the cost and efficiency ratios as banks continue their transformation investments in this inflationary environment?
Yeah, that's a good question. At their Q2 earnings calls, pretty much all the big six alluded to their expenses and that they were elevated and that they're going to be looking to moderate expenses going forward. I think, we've seen some of that with regarding to staffing and things like that. Now, they're still going to make their investments in their platforms, technology, and things like that. But the other thing to keep in mind is that as we progress through the quarters, the base increases, right? So you're working off a higher base of expenses from the prior year. And so, but to go back to the core point there on expenses, the big six are and have pretty much said that they're focused on moderating those expenses and being pretty efficient for the balance of fiscal 2023. And with regards to, when you look at the efficiency revenue ratio and revenues, there are going to be some pressures on revenues going forward if things play out as we expect them to. We expect loan volumes to continue moderating, despite the pickup that I had mentioned earlier in housing. The recent increase from Bank of Canada in June, and a lot of people are speculating there'll be another one in July, won't help that. And as well, we started to see those strong business loan volume increases moderate. So we do expect to see that continue, and as borrowing costs go up and people get a little more weary of the economic picture and the economic situation, if we're heading for a recession, demand for loans will also likely moderate, as will banks with their lending. They'll get tighter there. And be a little more selective around what they're lending to, such as example in the commercial real estate space, and things like that, which are areas of focus right now. So when you take those components in, which are loan volumes, and then you look at the net interest margins, which we also expect to continue moderating and have started doing that because of two reasons. Funding costs have gone up, particularly since the U.S. regional banking crisis in March. And as well, there's been a noted and significant shift from demand to term deposits. So while that's not necessarily a bad thing from a perspective, you're keeping that deposit base and you're keeping them in set terms for 1 year, 2 years, 3 years, your funding costs go up because you pay more for those deposits versus deposits that just sit in the bank account and virtually are nil. Right, so the combination of those two factors, and net interest margins, the negative impacts on net interest margins, as well as loan volumes moderating, which will likely put pressure on net interest income going forward. From the non-interest income side, it is really hard to predict what will happen to merger and acquisition activity. Some of the depressed markets that we've seen in capital markets, in the recent quarters, and see if some of that activity will pick up. So, through the balance of the year, we'll be looking at those efficiency ratios to see how the banks are moderating those expenses or managing their expense levels in light of the anticipated revenue pressures.
Oh, sorry, actually, I was trying to speak. I was on mute. Right. So there are like a couple more questions we received. So the first one, let's start with the first one actually. So there remain concerns around further actually correction or steep drops in the Canadian housing prices. Could large banks withstand something like 20-30% drop?
It's a very interesting question, and a couple of things to keep in mind. Sorry, give me one. A couple of interesting things to keep in mind here with regards to housing prices are that they went up roughly 50% during the pandemic to the peak in February of 2022. And if my recollection stands correct, I think by the Canadian Real Estate Association, they dropped during the housing slump last year, roughly 16%. And so, there's a long way to go to reach that 50% housing price inflation that happened, during the pandemic. The other thing is there's also some, as I mentioned earlier, some built-in drivers of demand that would likely put somewhat of a floor on housing prices. And again, that's record levels of immigration. We just saw there's an article that came out today that talked about Canada hitting 40 million in population, driven obviously and mostly by immigration. And as I noted, immigration drives consumption as well as housing demand. And then there likely is still some pent-up demand, for housing in light of the recent slump where those prices did drop last year. And then we have structural supply issues. There's just not enough housing, and there's not enough affordable housing. There's just not enough housing. And so, CMHC comes out with their numbers and we continue to see these challenges, and there's a lot of political challenges built into that as well with getting approvals and things like that. So, some of those issues need to be solved to increase the supply of housing, because with record levels of immigration, that's driving up demand for housing. And a knockoff impact of that is you're seeing rental prices skyrocket, right? And so, I don't know where that floor may or may not be in housing prices, but those demand drivers remain.
Oh, all right. Another question we received is, when was the last time OSFI increased DSB buffer before December 2022 and June 2023?
Okay, so if you bear with me for 1 minute, we produced a topical research piece last week after OSFI's announcement. I probably can recollect it, but instead of trying to recollect, I'll just go back to that piece because it was included in that piece, OSFI's history of the DSB and what they've done. So if you bear with me for a minute, just so I don't have to rely on memory. Yeah, so when I look at here, we have an exhibit in that piece that we published on June 20th. And it basically talks to the history of the DSB there. And so you'll be able to see in that piece that back in, and I'll speak a little bit about this, back in June of 2019, the DSB was set at 2%. Then what OSFI did was in December of 2019, keeping in mind that OSFI reviews their DSB on a scheduled semi-annual basis in June and December. So in December of 2019, they raised it 25 basis points to 2.25%. However, that increase never actually took effect because there's a phase-in period for those increases to take effect. And that increase to 2.25% in the DSB never took effect because the pandemic happened. So when the pandemic happened, OSFI did an off-cycle review, as they're able to do, of the DSB, and they lowered it by 125 basis points. So they lowered it from 2.25% to 1%. And that was done to effectively minimize the risk of credit seizing up. And it effectively reached, I think, about $300 billion in loan capacity. And so they kept the DSB at 1%. For a fairly long period, considering there was a lot of uncertainty around the pandemic and the impacts of that pandemic. But then once the concerns started to abate from the pandemic, they increased in June of 2021, again during their regular semi-annual review. They increased the DSB from 1% to 2.5%. So they increased it by a material 150 basis points to start building that capital, that top-tier capital buffer. And this is what OSFI will look to do. In good times, they look to build up that capital buffer so there is increased capacity to absorb losses. And then in bad times, they will draw down, as they did at the onset of the pandemic on the DSB, to give the banks more flexibility, releasing some of the capital, and also to continue lending, which is very important because you don't want things to snowball in a crisis. And so they set it at 2.5%, like I said, in June of 2021. And then since then, they've done their two recent semi-annual increases. They increased it from 2.5% to 3% at their last review in December. And then they announced the increase in last week to 3.5%.
Sure. Thanks, Carl, for your response. So we have a little more time to answer to your questions. If you have, please submit any of your last questions to your Q&A box. Meanwhile, we have only one question pending. So the question is, what implications does DBRS Morningstar see for both borrowers as well as banks from the tightening standards through OSFI's B20 guidelines?
So OSFI is currently doing a review of their B20 guideline, and there's a lot of talk about them tightening, although where it all plays out it still remains to be seen. But some of the discussion has revolved around tightening at the debt servicing levels. So in mortgage lending, there's what they call a TDSR and a GDSR, so a total debt service ratio and a gross debt service ratio. And each of the lending institutions will have their limits on those. However, they can't exceed those limits by requesting exceptions. And so there's a lot of talk around OSFI looking at those levels. And so we'll have to wait to see what the outcome of that is. As well, there's a ratio called LTI, or loan to income. And the Bank of Canada uses this as does OSFI to measure debt levels. And so another thing that's been spoken about is OSFI might put in LTI maximum limits and bifurcate the population, right? So some of these changes or updates they made to B20 might not be broad-based across everything. They might be, some might apply to higher risk, what are deemed higher risk borrowers, and so on and so forth. But they're still working through their consultation. I think the first phase ended a couple of months ago. And so my memory recollection is that I have not seen anything come out of that to this point. But, you know, we'll see how, what, if any, changes come out. I'm assuming some will, but it remains to be seen what those changes are. And then the other thing that's actually interesting in that space is that OSFI also sets on an annual basis in December what they call the MQR, minimum qualifying rate or mortgage stress test. So that's a built-in mechanism that OSFI has employed, where federally regulated banks have to stress test new mortgage originations or refinances, either at a floor of 5.25% or at the contract rate plus 2%. So, you know, prior to these interest rate increases, where interest rates were at rock bottom lows, the banks were testing at 5.25%. Now, obviously, with interest rates materially higher, they're stress testing at contract plus 2%. So that stress test was a built-in mechanism that added a buffer for the banks that helped to absorb some, or at least a portion, of these recent interest rate hikes. So, you know, OSFI is always reviewing that, and that MQR, a minimum qualifying rate, or as it's more commonly referred to in the market as a mortgage stress test, is part of the B20, right? So there might be a review of that MQR rate as well as part of their review.
Thank you, Carl, for your insights. So that was the last question we have received. Unless there are other questions, we could conclude today's discussion, and we hope that everyone found our discussion informative. The presentation will be available shortly for reply on Bright Talk and our DBRS Morningstar YouTube channel in the coming days. You'll also find a takeaway summary of the webinar on our website, dbrsmorningstar.com. If you have any further questions for us, feel free to reach out us directly. And thank you for your time and enjoy the rest of your day.
Thanks very much for attending.